We're here today to discuss absolute return bonds with Bregje Roosenboom. Bregje, welcome.
Thank you.
Can you provide us with a short overview of what's happened in the markets?
Over Q4, fixed income markets have been dominated by two factors, basically, the ECB policy making and the oil price. So first of all, in October, the ECB started with a purchasing program of covered bonds and ABS, which was quite supportive for at least those parts of the market. Second, in November, ECB announced that it would expand its balance sheet by another 1 trillion. Not any further details at that point. And then, of course, the big meeting was going to be in January, on January 22nd, where they would announce what would actually be done if QE would be started. And then we have the oil price. Since November, the OPEC decision was made that they would not cut production, which sent the oil price into a steep decline. Which was, first of all, a negative in most fixed income markets. But then towards the end of December, market participants thought, well, maybe this lower oil price could actually be a positive for global growth as well. And we saw that markets again picked up on in activity and also in the risk that they were willing to take. So again, we ended the quarter with historical lows in German bond yields.
Okay. And can you tell us what effect on performance these events have had?
Yeah. So absolute return bond fund over 2014 has shown a positive return of 1.25%. But the fourth quarter has been a little bit more difficult for the strategy. The main drivers for this negative performance was first of all FX. So we had, for example, long positions in oil-related currencies, like the Russian ruble, for example, and that weighed on performance. Another commodity-related currency, which is the Australian dollar. We had a long position in Australian dollar versus a New Zealand dollar. And the Australian dollar was hurt by lower iron ore prices. Also an important factor of the performance was in the beginning of the quarter an underweight in US duration, which of course everybody knows what happened there. Yes. And then another factor which is quite important is in high yield markets we've seen quite some outflows in high yield in general in the asset class, which was mainly done in cash bonds. We take positions in part of our component, which is called active alpha. We take positions in high yield cash bonds, for example, and then we hedge the beta with the CDX indices. And we saw that these short positions in CDX indices were actually outperforming the long positions in cash bonds. So yeah, that's hurt performance, and you can wonder if that would be something to remain in the future. And also we had some exposure to US oil-related names, which also was not positive.
You had mentioned earlier the ECB's announcement on quantitative easing. Can you share your views on that and tell us more about how you're positioned?
Yeah. So we feel that the ECB intervention, so the QE program, is not fully priced in. It surpassed expectations in terms of size and the extent to what they will do, so that it's basically open-ended. What we've done, we've participated in some new issues in European corporate investment-grade bonds. As the search for yield is back, we also would like to buy into some European high-yield names and some emerging market debt local bond countries.
Okay, thank you very much for joining us, Bregje.
Thank you.